Hey, what's happening, everyone? Thanks for joining today. We're going to go through the Home Possible program here. It is a lower down payment conventional loan that we'll get into, but let's get a little bit started here and get acclimated and introduced to each other. My name is Brian Barkowski. I am the branch manager here in Chicago for UMortgage. Our office is actually located in downtown Downers Grove on Main Street. We've been here for about 5 years now, and it's been a really good run for us to get started in its industry. As you'll see, as we go through my notes here, where we're at. So 5 years ago, we're a brokerage. We ended up starting out on our own. It was just a company that existed on a piece of paper a few years ago. And within a couple of years, we were able to go correspondent, right? We were able to lend our own money and take that next step, which was a big accomplishment for us and being able to establish what we were doing. But over the last couple of years, we kind of figured out our ceiling, right? I know how many loans I can do without pulling out my hair, and that's where UMortgage has stepped in. They have been able to provide such an opportunity for us to be able to grow, to be able to help better our clients. The process has been completely seamless from when we started, and we have way better options. I have way more options than I was able to provide before. So UMortgage has been a tremendous help for us in our business, and thank you to the marketing team and everyone else for helping put this together and asking me to present. So it means a lot, and looking forward to seeing everyone this weekend. All right, so let's talk about a little bit about what Home Possible is. And it is an affordable program from Freddie Mac. It is a conventional loan, okay? It is something that it is not an FHA loan, but it's a conventional loan that has a couple restrictions. It is something that you can have a lower down payment, and we'll just get into the details here. But that's what this is, and allows people to save some cash at closing, and then also be able to have, actually, you'll see even a little bit better rate when things get going. So let's talk a little bit about what the requirements are and how that works out. So you will see it is a 3% down conventional loan, right? So 97% loan to value. All right, so that's less than FHA, so you can save a little bit percentage there. And right, in a traditional FHA loan, right, your PMI is going to stay on for the life of the loan. In this scenario, when it comes to a conventional loan, once you do get that 20% equity, we'll get into that PMI would fall off. So it's a little bit different. And we'll talk a little bit about what affordable seconds are, right? So you'll see here, we can actually go to 105 total loan to value. So that means if you have a down payment assistance program, which we actually do at UMortgage, I'll get to in a second, but you can have a seller credit based on maybe a different type of government program or a private program. But this Home Possible does allow that to be joined with the first mortgage. So essentially, you can actually have 105%, extra loan on the home more than the actual value, which would then decrease your cash to close. Like I mentioned, here at UMortgage, we actually have a couple of those down payment assistance programs, DPAs, if you're taking notes, and they're actually forgivable, right? So we actually have a credit of either 2.5% or 3.5%. They're actually forgivable, so you can apply that to the loan, and then in 6 months, if you refi, you can actually get out of that loan and without penalty. So there's a little flexibility, something you can talk about with your local UMortgage loan officer, but that is something that the affordable seconds are allowed in this program, okay? You'll notice that there is no cash out option, right? We are just talking about purchases and rate and term refinances. So no cash outs in this program, but we do have the other two, right? The other point here, owner occupied. You got to live there, all right? It's not an investment program, but this is something for primary residences that you're going to end up staying in the home for a long time, all right? Super conforming, right? There's some restrictions. You're going to see here in a little bit that there are some income requirements. So it is a conventional loan, like I said, but it is going to have the other hoops or different requirements. You'll see that we have to jump through. Nothing crazy, but it is something that it is a little bit extra conforming that we'll actually have to jump through when we get to that point. All right, so we do have fixed rates, adjustable rates, right? Depending on your situation, your goals of how long you want to stay in the home, or what that, how that really works out for you, for your cash, your situation, investment of your resources, you can have the options, right? So most Adjustable are available, but conventional fixed rates probably where you're going to want to be anyway, right? Condos, PUDs, manufactured homes pretty much are covered when it comes to this program. So they're allowable for a number of different property types. So let's go into here again. We're just going to reiterate, it's our primaries, right? There are multiple property types, and it cannot be for investment purposes. All right. Again, no cash outs, only for purchases, rate term refinances, and for the conventional side, right, we're going to have a few more hoops to jump through. Like I said, little tease, it is the income one, which is really the big one. But you'll see how we work that and help our clients actually save rates, get a better rate, and save some money. All right, so let's go here again and talk a little bit about that down payment with our affordable seconds. Again, we do have some options for you guys when it does come to that. Maybe that's something we can chat about down the road. But it is for home buyers. They can bring less cash to close. They can get a second mortgage or a second credit on this program. So that's something to be educated about and to understand what those options are. Not required, but if that's something that is useful to the client and that's something they want to use, they are allowed. All right. Our credit score, our minimum credit score is 660. All right. So if you have someone who's on the borderline, I hope some of you guys know about this. And if you don't, here's a little tip for you. Once credit's pulled, we actually have a tool called the Wayfinder tool that allows us to see what could be paid off for clients and help them increase their score. So let's say we have someone at 658 as their middle score, and we needed to bump them up a little bit. We could actually see, this only works within 30 days, and it's not 100% accurate, but it does give you the percentage when you run the report. But if you do it more quickly, it actually is going to help that. But you could literally see, all right, if you pay off, $500 on this credit card, you could get to 660 within 5 days. All right. So then you just literally show your payment from your account. You show that statement, having that, lower balance, you submit it, and we can increase that score. So a little tip off the side, that can happen for any loan. It doesn't need to be the Home Possible one, but I wanted to bring it up here because it's a really helpful tool for clients to be able to help get them to either qualified or even save some money, right? You can go from a 720 to a 740 or whatever it is, and you can actually increase, get a better rate. So maybe the outlay for the credit is a little more than the rate. I digress. All right, but that's another tip for you down the road. All right, so the total qualifying income, 80% of the median income. Let's have a little fun here, and I'll show you how this works. So we're going to pull up a little property in Downers Grove, a couple blocks from the office, and I just did a quick Google search for Home Possible income limits, right? Super easy, find it, and I will show you this too. Just paste this in here. We're making sure that it's Downers Grove, and I'm going to zoom out just a little bit here. Oops. Cool beans. All right. So you will see the 80%. So it says our 100% median is 105,700. So we need to be at 80%, right? So it's 84,560. All right. So that means on the applicant, that applicant or co-borrowers, if it's both, their income cannot exceed that 84,560. Okay. So we'll get to how we can, we'll go our way around this. But this is what the income limit is. Now, one other thing I'd like to point out, you'll see here that only this area is kind of greened out. All right. There's different neighborhoods here in Downers. Like they actually go, not necessarily zip. I've actually seen it like neighborhood wise, even in the same zip code. I've seen it where if you click, if there's another property up here, like it might be a little bit higher or a little lower. It's not common, but I actually have seen it. So if you are doing a search, if you're a loan officer doing a search, make sure you search a realtor, take a look and make sure that you are using the right address if you do have that property, because it can vary from neighborhood to neighborhood. Okay, so we know how that works. Let's get back to our presentation. As I mentioned, all right, from the mortgage insurance is not required once we get 80% loan to value. Okay, so we can, this happen a couple different ways, right? We can either, once by paying down the mortgage, right? That's going to, get our loan to value better. Let's say you just home values, if they continue to increase, and no matter when, that increase in home value can be able to, help offset that PMI and maybe get rid of it. Or you put that new kitchen or bathroom in, right? That's going to increase your home value. So any combination of those, right, can lower, can get that income to, loan to value to 80%. So once you get that 20% equity, that PMI will fall off the loan. So that will be also a savings down the road. So a couple different things you can do in that regard. All right, so who's this good for? All right, so I've had the opportunity, I mean, a number of clients, but it's really fun to be able to kind of have these conversations with clients, take a look and see, all right, here's where having all these different options to really be able to see what makes the most sense for them, to be able to save money, to achieve their goals in whatever situation it is. And that's really one of the things that we are really trying to do here. And with all of the options that we have at our disposal now, we can really make that happen in this program specifically. So let's talk about some seniors. All right, maybe they're downsizing, right? They want to be able to get to a ranch, or we're going to a condo. And our income is, right, Social Security, or maybe it's, retirement income, pension, or we're doing a withdrawal from your investment. And that's a little another tip. If you do a withdrawal from investments, right, you just have to have your accountant say, hey, 3 years of withdrawals, and you can actually qualify that income as income to offset your debt to income. So another little nugget for you. Doesn't matter what loan, for the most part, conventional wise anyway, but that's how that would work too. So if you wanted to use your investment income, you could actually do that and draw, having a letter from your accountant for 3 years. So just thinking about that situation for seniors, right? This could be a viable option for them to be able to get into that home or to downsize for whatever their goals are. All right, first timers. All right, these are one of my favorites. All right, as I mentioned, I had the chance to do some education at Brother Rice back in the day before doing mortgages, and a lot of my former students are first timers and now clients, and it's been so fun to be able to actually see these guys grow and to be able to help them get home. It's been a fun chance I didn't really think I'd get a chance to do. So these are my guys here now, just out of college, right? They're making 50, 60 grand a year. They haven't saved up enough for the down payment yet because they're just getting started, or they just want to end up saving the cash, right? They have a chance to be able to qualify, right? They don't want to rent. They know they want to get in and be able to start investing and, building equity right away. So let's talk about, this is something they can do and be able to start on their own. Now, the other thing that is really cool about this, gift funds are allowed. So mom or dad or aunt or uncle, that's got to be a relative. They want to give them a little fun, cash or maybe a graduation gift and say, hey, here's 5 grand towards the down payment, right? Totally doable. Now, a couple things to think about or remember when we're talking about gifts. They got to be traceable, right? You can't just send cash to Johnny's bank account. That's not acceptable. But, if it's traceable, if it's from a blood relative, right, those gift funds can be used. So make sure you're working with your loan officer who understands how that works. But that's how that, you could be applied for the gift funds. So that is something to consider for this group of buyers. All right. Another one. So let's say long-term roommates and you're looking to live together and you want to be able to build some equity, but only one of you maybe is ready to take on the ownership of the home. But you can also maybe, your roommate pay some rent and you can offset some of that rental income when it comes to debt to income. All right. And that's something we probably should have gone over to when we talk about debt to income. Quick example, right? If we're making $5,000 a month, we have to have our debt to income under like 45%. So we're under exceeding our liability is about less than $2,500 a month. So you can actually apply that. So if you're tight, you might be able to use that and increase that level to be able to get you qualified. So that is another tool that you can use for this program. So not necessarily investment, but it is a way to be able to have a first timer, so to speak, get some of that help from monthly rent and be able to afford that place and get them going when it comes to building their equity. All right, and then we have another option really when it comes to married couples. All right, I love having this conversation with them and taking a look and saying, all right, here's where you are together, right? Together, you guys make $150,000 a year. You're doing great. But if only one of you are on the loan, we actually could save some money and get a better rate. And that's where I have these conversations with clients. And sometimes, it's not, they don't understand, but here's how this really can work. All right. If you have only one person on the loan, you can both be on title. So that means that, you both would have home ownership. You can take it anywhere. There's no restrictions when it comes to, taking how you title and sole ownership or tenants by the entirety. It doesn't matter. But you can have both on there, even though one person's on the loan. So if we're buying that home in Downers Grove and one of us makes 60 grand versus the other one, making 120 grand, then we can take that 60 as long as we qualify it, that income and everything. But if they do qualify on their own, then we can actually get a better rate and a lower monthly payment. So just real quick, I show an example that I ran this morning before this today. I was looking at a $400,000 loan amount. All right, we're looking at a 740 credit score, and we're looking for just a single family home. But when I priced out the 5% down, conventional, normal, what we would get into, the rate was actually an eighth worse than putting down the 3% home possible option, right? And that's going to mean in that scenario, right, it's going to save 2% cash down. So we're going to save $8,000 right there. That's going to save a couple bucks per month. Not the end of the world, but it'll take some savings. But I really like that. You're going to save that cash and get a better rate, so you can utilize whatever you want to do with that cash. Maybe that is for the bathroom. But that's the options you want to take a look at. So for these couples, right, I'll have that conversation. Say, hey, you totally can do the 5%. It is entirely up to you. But here's an option for you if you don't want to both be on the loan, but you can both be on title. I do present this option, and it's really good for clients because, again, they're saving money when it comes down payment, and they're saving the rate a little bit per month. So again, for clients, we always provide options, and that's what I love to do. And hey, what makes the most sense for you, right? So some people will actually choose a 5% down route. Cool, no worries. But at least in the day, like, this is what we're doing and providing these options and opportunity and information for our clients, and the education to be able to inform and let them make the most educated decisions for themselves. So right on. Well, I'm a little bit early, but are there any questions that we have from the group that you might want to ask right now? Let me know. Cool. All right. Well, from Donor's Business. Sorry, I did see that. I do think you can actually use business accounts. It's not necessarily gift funds per se from the business, but you'd have to verify using the the bank account from the business. If you're self-employed, right, then you could potentially qualify using those as assets for the down payment. It necessarily wouldn't be a gift, but could potentially be used when it comes to qualifying the assets themselves. So thanks for that. And if you have any other ones, like I said, type in and I'm happy to answer them, but that was the one I had. And if not, I just want to say thanks. I am very excited for you guys to be here today. Thank you for the opportunity. And if any questions, feel free to reach out again after this presentation. So thank you.